Welcome viewers. I, Anubha Lodha, Business Analyst at BSc Brokers Forum, would like to welcome you on this new initiative taken by Investor Education and Welfare Association and BSc Brokers Forum on spreading investor awareness and financial inclusion. Now to begin with the session, let me introduce our first session and our first speaker of the day, Dr. Aditya Srinivas, who will be taking session on secondary market.
Welcome viewers to this learning initiative undertaken by IEWA, that is Investor Education and Welfare Association, and the BSc Brokers Forum. Myself, Dr. Aditya Srinivas, working as a Chief Operating Officer with BSc Brokers Forum. Just to give you my brief profile, I have done doctorate in economics, MBA gold medal and MDP from IIM Ahmedabad. Having 10 years of corporate experience of various broking houses. During this period, I have presented 19 research papers in national international conference, 15 research papers in various magazines and journals of national and international repute. Apart from this, friends, I have also addressed various types of dignitaries like the German delegation, the France delegation from the respective countries along with their team of economists, people from London School of Economics, Assistant Commissioner of Income Tax, Mumbai Division, SEBI officials for one-day training program, and corporates like L&T Finance and Tata Mutual Fund, to name a few. Friends, in this initiation, we will be taking various concepts of capital market, and to begin with, I will be discussing today secondary markets, that is the function of the stock exchange, how does a stock exchange work, what are capital markets, money markets, most importantly the reforms that has taken place in the last one decade, and apart from this, the various types of capital flows that comes into the stock markets and how these capital flows affects the working of the markets. Now we shall be taking one by one various aspects of secondary market. Let us first understand the most basic primary question, that what is a stock exchange? There is a lot of misconception in the market. The stock exchange is a place where trading or gambling takes place. But friends, in reality, stock exchange is a place where buyers and sellers meet. It is a bridge between the demanders of fund on one hand and the suppliers of fund on the other hand. Let us take a very simple example of current capital market. Say the IPO of Coal India. Coal India raised 15,000 crore rupees from Indian capital market, and it was on the demanders side. On the other hand, retail investors like you and me, FIIs, mutual funds and several institutional investors including HNIs were on the supplier side because they wanted a good opportunity to invest in. Thus, stock exchange plays a vital role. It acts as a bridge between the demanders of fund and the suppliers of fund. The most important economic rationale of a stock exchange is to canalize savings into investments. That is, the household savings, which is around 12% of Indian GDP, has to be canalized into productive investment, and stock exchange plays a vital economic function by giving good investment opportunities in the form of IPOs coming in the capital market. Now let us understand who are the participants in the secondary market. There are various participants like the government itself. You may get a question, how government can be a participant? Let us recollect the fact, friends, that government itself has set a disinvestment target of 30,000 crore rupees per year to reduce the fiscal deficit. And this can be done by bringing IPOs of PSU companies where the government is having a substantial stake and wants to dilute it by floating IPOs in the stock market. Hence, government itself has become a major participant in the growth of capital market and wants that more and more people, that is the retail investors, should take the benefit of capital market. Second participant, if we take, are the companies which are already listed and which aspire to list on the Bombay Stock Exchange as well as the National Stock Exchange. Currently, around more than 5,000 companies are listed on BSE, which makes it the second largest exchange in the world in terms of listed companies. Then we have institutions, that is foreign institutional investors and domestic institutional investors, which are referred to as FIIs and DIIs. FIIs and DIIs play a vital role affecting the secondary market, since they are the ones who dominate the direction of the market. If we encapsulate some figures, then in the year 2007, FIIs were net buyers to the tune of 70,000 crore rupees, which took the index to the magic figure of 21,206. But again, the same FIIs in the year 2008, when there was global financial crisis, sold away 52,000 crore of shares from Indian stock markets, which brought down the index from 21,000 to 7,697 on October 24, 2008, which was one of the lowest points the index touched in that year. This shows the power of institutions, especially the foreigners in our capital market. The fourth and the most important participant is the retail investor, that is people like you and me, who are the backbone for the growth of any economy and especially any secondary market. Retail investors, as per SEBI guidelines, is an investor who makes an application of less than 2 lakh rupees in an IPO. If the application of the retail investor is more than 2 lakh rupees, it would go to the HNI category. Last but not the least, mutual funds are again a major participant, since they also canalize small savings of the people into the capital market. Currently, India has around 44 mutual funds AMCs registered with SEBI, who manage a total AUM of 5,87,000 crore rupees. Now friends, let us understand the history of stock exchange. If we see, BSE was formed on 9th July 1875. It is the oldest stock exchange of Asia and that of India also. Its original name, or historically it was known as the Native Shares and Stock Brokers Association. At that point of time, the membership fees was merely 1 rupee. One may feel that what is this 1 rupee membership fee? But friends, think of the time frame, that is before 150 years, even 1 rupee was considered a luxury. And at that time, the exchange had around 318 members. As of today, the exchange is having 1,383 members, which are members of Bombay Stock Exchange. After understanding, friends, this basic framework, let us take a look at the reforms that has taken place in the capital market in the past decade. As we all know that Indian economy, or our history of Indian economy, can be bifurcated into pre-liberalization era and post-liberalization era, where in 1991, when we had severe balance of payment crisis and India had to mortgage 67 tons of gold with IMF and had to take a loan, that was the era where the reforms were ushered in the economy. And on 24th July 1991, we started with liberalization, privatization and globalization that formed the 3 pillars of our economy, based on which today economy is considered as the super growth engine by 2020 by the world fraternity. In 1992, we did again a landmark step by allowing FIIs to invest in India. As of August 2012, currently 1,754 FIIs are registered with SEBI, and cumulatively in this year 2012, so far calendar year, they have invested net 61,000 crore rupees into Indian stock markets, which runs to around $13.7 billion. In the year 1993, we allowed one another major development, that is private sector mutual funds were allowed to conduct business. Till 1993, there was only UTI, Unit Trust of India, and some public sector mutual funds like the State Bank of India, who were into the mutual fund industry. But with the entry of private sector mutual fund, the retail investor and the common investor has benefited a lot, because it provides them an indirect entry to the capital market fraternity. And especially for those investors who do not have the time or the knowledge required to have a direct entry into the stock market or the secondary market. Mutual funds thus have become a tool for common investor to invest. As such, Indian economy has a total savings rate of 37%, which is highest in the world as compared to the world's average, which is only 24%. This has ensured that India was able to survive the global financial crisis of 2008 and the recent Eurozone crisis of 2011, which were primarily due to the leverage balance sheets of those economies and very poor savings ratio. Here friends, the year 1996 saw SEBI bringing out guidelines for mutual funds. But before SEBI was formed under the Securities and Exchange Board of India Act 1992, there was an old act known as the CCI Act, that is Controller of Capital Issue Act, which was more of a hurdle than inculcating more investments into the economy. In 1992, when SEBI Act was passed, the CCI Act got cancelled, and SEBI's role is not only just to regulate the markets but also to develop the Indian capital market in various prospects. This has ensured that the various reforms undertaken by SEBI so far has always proved helpful to the market and has ensured that the market grows by leaps and bounds. The year 1996 saw a very major development, that is passing of the Depository Act, and this was the first move towards what we can call it as a paperless trading, that is from the physical share certificate we moved to a electronic era where Depository Act was passed and two depositories, namely NSDL and CDSL, were created. This helped to shorten the settlement cycles, which in turn gave more confidence to the investors to come to the secondary market, and ultimately we are now in a position to have a settlement cycle of T+2 rolling days. Friends, here I would like to focus on the role of secondary markets in the economic development before taking further set of reforms. Economic development, that is GDP, can grow if individuals spend more and if they invest more. Secondary markets provides a good opportunity to buy shares of good fundamentally sound companies, which if kept for a considerable duration helps to have wealth maximization objective. For instance, if we take a real life example, if one invests 9,500 rupees in Infosys IPO in the year 1993 and has allowed that shares to lie in the demat account, in the year 2008, roughly it gets converted into wealth worth of 2 crore rupees. What can be more particularly powerful than the power of equity? Here I would also like to focus that if we take the CAGR return of Sensex right from 1979 to 2009, that is the 30-year period, the CAGR return of Sensex comes to around 17.25%, which is absolutely astonishing and higher than any other traditional financial instrument, and it also proves that it beats the inflation by a big margin. So friends, always remember that equity and secondary market is a product for long term, and if invested in a prudent way, it definitely helps you to create or achieve the objective of wealth maximization. Now friends, let us understand some of the other reforms that had taken place. Like in the year 2000, we had derivatives market gets going, that is we started with the futures and options segment. This segment is specifically important for any markets to attract FIIs into the economy. Since FIIs require a hedging facility, derivatives market helped them to hedge their risk, and this inculcates more institutional participation in the equities market. Apart from this, the year 2003 saw commodities market making a gateway into the Indian investment boutique, and commodities today, with only retail investors being participant, is clocking 70,000 crore rupees of volume per day, which is really a sign that retail investors are taking keen interest in the trading of gold, silver, which is referred to as yellow metal or the bullion, as well as energy products, crude oil, metals, and even agri commodities. Thus, this has opened a new gamut of investment products for the retail investor. The year 2008 saw currency futures being launched. currency appreciation and depreciation has always been a major concern. But with the currency futures, one can easily hedge dollar, yen, pound and euro, which are the four major currencies that are traded in our markets, and one can also speculate on them, thus giving everyone an opportunity to make money by having a position either long or short depending upon his view in the currency futures market. The year 2011 and 12 are noteworthy since in these years MCX became the first stock exchange to get itself lifted, and that has opened a clear-cut way for other exchanges like the BSE and the NSE also to get itself lifted and become listed entities. The year 2012 saw MCX launching the equity segment also, which would again provide a healthy competition to the market and also a flavor of variety for the participants. SEBI has now allowed the lifting of stock exchanges, which would bring in more professionalism, transparency in the working of these public institutions and also attract a lot of institutions to take stake in these particular market institutions. If we just try to wrap up the current scenario, then currently we have around 23 stock exchanges in India, but the major ones are the Bombay Stock Exchange and the National Stock Exchange that was formed in 1994. If we have a look at the daily turnover figures, then the BSE cash segment has roughly an average turnover of around 4,000 crore rupees. NSE has around 12,000 crore rupees cash segments, and in futures and options, recently BSE has become the third largest options exchange in the world by clocking a volume of around 1 lakh crore rupees daily, whereas NSE F&O is also clocking roughly the similar kind of volumes. Thus friends, looking at the turnover figures, one always gets excited, but one has to always remember that equity markets are for long term, and there is a statistical proof called as a rolling return of Sensex, which clearly states that if one remains invested in the market for around more than 10 years, the statistical probability of your making a loss comes to negligible. So this is a clear message friends, that one should not only have knowledge, but one should apply this knowledge and take benefits of the secondary market by investing in good companies and trying to achieve the objective of wealth maximization. Let us understand the two major concepts of financial markets, that is capital market and money market. Capital market friends is a market for long-term source of funds and would always have a maturity of more than 1 year. The general instruments traded or available in these markets are the equity shares, preference shares, bonds and debentures. We'll quickly understand what are their features. Equity shares are normally the shares which are of ownership and this capital remains with the company till the company goes for liquidation. As far as preference shares, bonds and debentures are considered, they have to be repaid back along with the dividend or interest, whatever the case may be. Thus, equity shares represent ownership capital, preference shares, bonds and debentures represent debt capital or borrowed capital. Friends, one has to understand that if we look at the historical perspective, that is after Second World War, why did US, UK, Japan in a short span became world super economic powers? The hidden truth lies in the growth of their capital markets. Whenever capital markets, secondary markets are well developed, the economic growth always is high since companies get more funding opportunities when they are a part of the secondary market. This helps the companies to expand their business activity, which in turn generates a lot of employment opportunities, and ultimately this creates demand and consumption in the economy. Once this is done, automatically the GDP starts rising and overall the economy makes progress very fast. Thus, one has to understand that capital market or secondary market and economic growth of a country are closely interlinked, and they are not independent but interdependent on each other. Now, let us understand the concept of money market. Money market, friends, is basically a market for short-term source of funds, and it is basically having a maturity of less than 1 year. the primary objective of money market is liquidity management. Here there are instruments like treasury bill, commercial paper, intercorporate deposits and certificate of deposits, which are used by banks, financial institutions and even the government for managing their short-term borrowing purpose. One thing I would like to highlight here, friends, is that the treasury bill was the same instrument for which the US government was downgraded in August 2011 by Standard & Poor from AAA rating to AA rating for the fear that US economy may have defaulted on repaying the treasury bills. As of now, China has invested $1.1 trillion in US treasury bill, and Indian government has also invested roughly $39 billion in US treasury bills. So this shows the importance of these instruments, that how vital they are to keep the economy alive by providing liquidity for short-term fund management. In money market, there is one very important concept known as a call money market. It is a rate which shows you the short-term liquidity position in the economy. And if we try to take two real-life examples, in 2007 October, when the world economy was in a very bullish mode and markets all over the world were claiming new heights, the call money market in India quoted a rate of 0.25%, which shows that there was excess liquidity into the system. On the other hand, exactly 1 year after the Lehman Brothers crisis in October 2008, the call money market went as high as 21%. Now friends, here the point is that neither 21% is desirable for the economy, because it shows that there is complete liquidity dried up in the markets, and on the other hand, neither a low rate of 0.25 is desirable, because in either situations the economy gets hurt. Normally, the call money range for Indian economy is between 5 to 6%, and that ensures that sufficient liquidity is available into the system. Now friends, if we try to understand that after capital market and money market, a brief overview of the companies that are listed, then we have around 6,000 companies which are listed on Bombay Stock Exchange and roughly 2,500 companies on National Stock Exchange. This makes BSE the second largest stock exchange in the world in terms of listed companies. Apart from this, friends, when we are talking of secondary market and stock exchanges, we can never forget the regulator, that is the Securities and Exchange Board of India, which is the primary agency which controls or rather regulates and develops the Indian capital market. SEBI has three main objectives: to develop the capital market, to regulate the capital market, and third, to protect the interest of the investors. And that is why this agency time and again has been instrumental in ensuring that small investors are taken care of and their interest is always at the helm of the affairs. And many times it has taken decisions against those who have done scams in the market or who have done any kind of wrong activity, and by punishing them it has set a right standard in the market, that market is for fair practices and not for any kind of manipulation. Now let us understand the relationship between the primary market and the secondary market, because it is both are just like two sides of a same coin. In secondary market, if there is a bull run, then only more IPOs will come in the primary market, because if the markets are in good condition, companies get higher valuation and investors are also willing to come and fill the forms. On the other hand, if there is a bear run, for example 2008, when there was severe global financial crisis, no IPO or no company dared to bring an IPO into the market. Thus, the primary market and the secondary market are interlinked and they are not independent. So one has to understand that there is a deep relation between these two segments and both go hand in hand. Now if we see the years of 2007 saw lot of IPOs since the markets were in bull run. The year 2008, after Reliance Power IPO failure, hardly any company dared to come out with an IPO because the world economy was saddled with the global financial crisis. And the year 2009, which again witnessed recovery in the world economy, the stocks started rising again and more IPOs started coming back to the floor of the exchanges. Here friends, when we are talking of stocks, let us try to also understand the classification of shares, that is mid cap, small cap and large cap shares. Generally, those large cap stocks are referred to as having a market cap of greater than 9,000 crore rupees. These are the stocks which are fundamentally very sound and normally represent the indexes. Stocks which are between 2500 crores to 9,000 crore of market cap are referred to as mid-cap stocks, and stocks between 250 crore to 2500 crore are small cap, whereas micro caps are less than 250 crore. Here one needs to understand that lesser the market capitalization, the more is the risk for the stock to get manipulated, since it clearly indicates that the floating stock is less in the market or the number of trades are very less in that particular counter. From June 2013, SEBI has going to make it mandatory for all listed companies to have 25% compulsorily public holding. This will ensure that the floating stock in the market increases and chances of manipulation goes down. There is another classification for shares which are referred to as A group, B group, T and Z. A group shares are normally the ones which are fundamentally very sound and are often referred to as the blue chip companies. For example, Larsen & Toubro, ICICI, Reliance. B1 and B2 represent fundamentally good companies, but they are relatively small in size. For example, Bhushan Steel or Praj Industries, something like that. The problem comes in the T and Z, whereby T group refers to trade-to-trade category, where only delivery based trading is allowed and no intraday is allowed. A stock is referred to in the trade-to-trade category when there is abnormal volatility in the stock, or when the exchange feels that there is something abnormal or wrong thing happening in this particular share, so it is shifted to the T group category. Z group, as the name itself indicates, are the last alphabet, and these are normally those companies where there are a lot of allegations regarding promoters. They have not filed income tax return, they are not paying the listing fees, and there is a big risk that these companies may get suspended or delisted at any point of time. So it is an indicator to the investor that it is better to avoid this category of stocks, and that is why exchange puts them in Z group category. Now friends, after understanding the classification of shares and other things, let us understand the settlement process. Currently we follow a T+2 settlement cycle, whereby suppose a trade takes place on Monday, it will be sorted out after 2 working days, that is Tuesday and Wednesday. On Wednesday in the morning, the paying of funds and securities will take place in the system, and in the afternoon the payout of funds and securities would take place. Indian markets in the world are one of the most efficient markets and has the best settlement processes, since all trades, when they take place on the floor of the stock exchanges, they are counter guaranteed by the clearing corporation of the exchanges, which ensures that there is no counterparty default risk.
Now sir, to further go ahead, can we have some question and answers?
Sure.
Okay sir. So my first question would be, can you please tell me role of secondary market in developing economy?
See, secondary markets have played a vital role when it comes to developing an economy, for the simple reason that when the companies which are listed on the stock exchanges raise funds, they expand their businesses. This in turn creates lot of job opportunities in the economy. When job opportunities are created, obviously there is spending power with the consumer, and as a result demand and consumption picks up. The GDP, which is a function of demand, is nothing but demand is a function of employment, and that is where India has always outperformed the global economies. If we see, more than 70% of our working population is less than 35 years of age, and this has ensured that we have a lot of disposable income, which if channelized properly into the capital markets, not only the markets will grow, but the economy overall will also prosper and bring even the good retail investors back to the market.
Sir, can you please tell us the role of stock exchange in economy?
Dear friends, secondary markets have a major contribution towards the economic development, as the companies are listed, and when they raise funds through the secondary market, they expand and diversify. With this, there is lot of employment creation and job opportunities in the economy. When the income of the people goes up, obviously it increases their disposable income, which in turn brings out spending of the consumers. This consumer spending creates demand, and ultimately the GDP of the economy rises fast. Thus, the impact of secondary market on the economy is very important. And historically also, if we see economies like US, UK, Japan, they have developed significantly as their capital markets were well developed and were able to help companies and entrepreneurs raise capital, which in turn has ensured that their economy grows fast.
So my next question is, what can be the impact of capital reforms on market?
Friends, reforms have always been a matter of debate and concern for the growth of Indian economies. If we see the reforms that we started in the year 1991, when our balance of payment was only 2,400 crore rupees, which was sufficient for only 2 weeks of import, with what we have today. Due to these reforms, we have been able, today Indian economy has a forex reserve of $300 billion, which is equivalent for 9 months of import. Thus, reforms have always played a vital role on the capital market. And if we see, the September 2012 is again a very important period, since the government has ushered in a lot of new reforms like FDI in retail, FDI in aviation sector, and cap on the subsidies, which would help the government to reduce the fiscal deficit. The stock markets have already given a thumbs up to this kind of reforms, and as a result, markets are substantially going up and trying to touch even the 19,000 level, which would again be a psychological mark. Thus, reforms always had a major impact on the investor psychology, the foreign investor psychology, and overall sentiment of the economy regarding the secondary market movement.
Going further with the questions, my next question is, can you please elaborate on classification of market and their role in development of economy?
Dear viewers, there are two main kinds of classification when we talk of markets, that is a capital market and a money market. Capital market, as we have understood, is a long-term source of funds where companies come and raise money. For example, Coal India, which raised 15,000 crore rupees of ownership capital in the form of IPOs and thus strengthened its balance sheet. On the other hand, money market is a market for short-term source of fund, and the objective is liquidity management. Primarily in capital market, retail investors are the key ingredients, whereas in case of money market, we have banks, financial institutions, and most importantly even the central government and the central bank being the major participant. Thus, both segments of the markets are important, since a vibrant capital market would ensure that retail investors come to the market, they invest and prosper. On the other hand, a sound money market would ensure that the banking system and the overall liquidity into the economy is in control and in sync with the overall economic growth and development of the objective.
So my last question of the session is, what are the type of capital flows in economy and also their impact on economy?
This question is perhaps the most important and the most debatable, since every economy attracts two types of capital, that is FII flows, that is foreign institutional investors flow, and the FDI, that is foreign direct investment. Apart from these two flows, if we take FIIs, they predominantly invest in the stock market and they follow good GDP number, whereas FDI flow basically helps to create good GDP numbers, that is it directly contributes to economic productivity, brings in employment, new capital, and helps the real economy to grow. India in the year 2011 attracted $50 billion of FDI flow, and in a recent United Nations report in July 2012 has been ranked as the third best FDI destination in the world after US and China. Thus, India as an economy requires both kinds of capital, that is FII also and FDI also, because without FII flow we cannot have capital market, that is the stock market, reaching new heights, and without FDI flow we cannot have the real economy rolling and achieving a GDP growth rate of 8 to 9%, which is the base for our economy to be called as the super economic power.